I'm David Wessel from the Wall Street Journal. I'm joined today by Bill McNabb, who's the chief executive of Vanguard, which manages $2 trillion, that's trillion with a T, in mutual fund assets. Thank you for being with us.
It's great to be here, David. Thank you for having me.
So today happens to be the day that the president's budgets come out. I know you haven't read all 2,000 pages yet.
Night reading.
Yeah, right. But in the big picture, we've had a series of fiscal cliffs here. We seem to have gridlock in Congress, yet the stock market keeps going up every day. Does what go on in Washington with the budget really matter to the markets and the economy?
I think in the long run it matters a lot. You know, there's not a big correlation between macroeconomic growth and the stock market in the short run. But and if you think about what's happened in the U.S., companies have done a great job, managing their balance sheets, driving margins to higher levels, and the stock market is now rewarding that. But what you're not seeing as much is top-line growth. And you don't get top-line growth if the economy's not expanding more robustly.
Top-line meaning revenues. They're not selling more stuff.
Yeah, it's really been, this has been much more focus on profit margins than anything else. So if you want to see a return to top-line growth, eventually your economy has to grow much more robustly than it's growing right now.
And do you think that it's not growing faster because Washington isn't doing more about the deficit? I mean, what's the connection?
I think the deficit is a huge overhang. We've termed this, we call it the uncertainty tax. And our economists have actually done some calculations about it. And we think it's a full 1 percentage point drag on GDP for each of the last 2 years. Another way of thinking about it is, roughly 45,000 more jobs could have been created each month for the last 2 years. And when you put it in those terms, this fiscal uncertainty that we have is really a pretty big drag.
Now, one of the things that the president proposes, maybe the kind of certainty you don't want to see, is for the first time to say there's going to be a limit on how much a high-income person can save for retirement. Roughly $3 million in your tax-advantaged retirement account. Now, you're in that business. You think this is a good idea or a bad idea?
I think anything that disincentivizes people from retirement saving is not a good idea. I haven't seen these specific provisions here, so it's hard to opine specifically, but limits to the retirement plan system today when Social Security and Medicare are really not sustainable the way they've been constructed. I think we should be doing everything we can to incent people to use the private retirement system more aggressively. I also think, by the way, and this is more tactical, but just the way we calculate the benefits and costs of the retirement system are pretty flawed. And as you know, the CBO does it on a 10-year basis, and retirement plans end up looking like one of the big costs, if you will, from a tax perspective. The reality is, if you look at the whole life cycle, all you're talking about is the timing difference between when the money goes into the plan and when the money comes out. And when you take a net present value of that difference, it's a much smaller tax, if you will.
Right. You mean that the things that we say cost the government money cost us in 10 years when people are putting money into the retirement plan. But 40 years from now or 30 years when they take it out, we get tax revenue on it, doesn't show up.
That's right. And we know, or we suspect we're not going to take tax revenue out at a lower tax rate than today.
Right, right. Now, another thing that's going on and getting a lot of attention here in Washington is the Fed has been pretty aggressively buying bonds, $85 billion a month. And some people think that we're building a bond bubble, that interest rates are so low that they can only go one direction up, and that a whole lot of people who have money in bonds don't understand the risk they're taking. You must have a lot of investors who are in bond funds. What do you tell them?
Well, first of all, on the broad point, I'm worried about it. I think within the capital markets, what's happening in the bond market is probably the most troubling issue we have. Just to put some math behind it, if you look at historical rates, we're running inflation between 2.5. So a money market fund should yield 2.5% today. Yields 1 basis point. If you go farther out the curve, treasuries should be, at 10 years and at 30 years should be yielding 150 to 200 basis points more than they are today. So this is a real artificial dampening of what's going on. So what we tell investors is to think about why you're in bonds. And I think 2 of the 3 reasons why people invest in bonds are still very legitimate. A lot of people invest in, just for the income. And, they don't need the principal, they just want the income thrown off by the bond fund. actually they should hope for a gently rising set of rates, because if that happens, they'll see their payments over time grow, and it'll be a good thing from an income perspective. If you're using bonds to dampen the volatility of an equity portfolio, so you've got a more balanced perspective, it's still not a bad thing to be invested in bond funds. If you're investing in bonds purely for a total return perspective, you got to do the arithmetic, and the next 10 years aren't going to look like the last 10 years.
You mean people are buying in bonds because the bond market has been going up, so they say, well, that's great, I'm going to put my money in bonds, but we kind of know it's unlikely the next 10 years are going to look like the last 10 years.
If you look at the last 10 years, bonds have returned 5% a year, and with relatively low volatility versus equities, and so people have been attracted to that. Plus, there aren't any real options on the short-term side. So the next 10 years, if you just look at the yield to maturity, of a 10-year bond, it's about 2%. Mm-hmm. So that's your best predictor of future returns. So 2 a year versus 5 a year, huge difference.
Mm-hmm. Well, do you think the Fed is making a mistake by running this policy?
Look, Chairman Bernanke and the Fed have had the most difficult job anybody could imagine, and they've steered us through pretty adroitly. I do think the longer this goes on, and the bigger it gets, the more the distortion impact. It's just really hard to figure out what's going to happen.
Right.
And
right.
Typically the longer and bigger something artificial goes on, the bigger the consequences are. So right. It's getting concerning at this point.
When I look across the entire world economy and think about where could the disturbance come from that throws us off course, it's kind of hard to avoid stumbling over Europe right now. So when you look at Europe, what do you think?
So I think Europe has got some long-term structural problems that are going to take a very long time to work out. If you think about the reaction to the financial crisis, Europe was very slow to react. It's really
right.
not a homogeneous economy. And, in a sense, the U.S., and again, give the Fed a lot of credit here, bank balance sheets, the financial system is in much better shape here than in Europe. Europe is several years behind us on that, and it's much more difficult to coordinate. So I think Europe's going to continue to be a source of problems. And by the way, it's to loop back to your earlier question on our fiscal situation and fixed income and so forth. I think one of the reasons it's so important for us to get our fiscal house in order is that it will make our economy able to withstand some of these unexpected shocks from other parts of the world. Europe. There's going to be problems come out of Europe over the next 10 years. I don't know what they're going to be, but it's not going to be smooth sailing. And I think the stronger the U.S. is, in a sense, the better we can insulate ourselves from that.
Good. Well, thank you very much. I'm Dave Wessel from the Wall Street Journal. I've been joined today by Bill McNabb of Vanguard.